Hello, good morning.
Good morning, sir.
Good morning, sir.
Morning, sir.
Good morning, sir.
Good morning.
Good morning, sir.
Good morning, everyone. Are you able to hear me?
Yes, sir, you're audible.
Right.
Yes, sir.
Right. So you need to switch on your videos. If you have any technical problem, I don't disturb you. And I assume that you have already informed the teaching assistant or the MBA office well in advance. I don't do any cold calling. I believe that we all are mature. We are here to learn. If you're interested to learn, you learn. Otherwise, you're not. That's all. As simple as that. I don't force anyone to do anything. Right. So be clear on that. I will never do the cold calling. Okay. If you are participating, you are participating. If you are not participating, you are not participating. You are not a kid. You are doing your post graduation. Okay. You know my name. My name is Surender. I will take you through this course on foundations of finance. Okay. I believe this is the first course in finance. By the way, I mentioned some time back, when I met you during the orientation program, I said that accounting is not finance. Accounting is a bookkeeping language. For most of you, I believe that this is the first course in finance. So, let me make a tall claim. I don't know whether I will reach that, but let me make a tall claim that I will try to, unlock the spirit or animal spirit towards the financial markets. Unlock, or ignite your minds or generate some kind of interest, towards the financial markets. Whether you wanted to specialize in finance or not, it's not going to make any difference to me. Okay, but yeah, I will put all my efforts to generate that interest. Okay, so that's what it is. I know that some of you are already pre-decided. So if it's already pre-decided, there's nothing I can change, right? So right. Okay, by the way, whatever we discussed during the orientation program is also part of our course curriculum. Okay, so if you rightly look at by the way, it's very basic course. It's very, very elementary course. If you have glanced through I don't know, have you received the course outline? You can speak out.
No, sir, we haven't received the course.
I don't want to, you don't need to be making any signs or anything. You can speak out. Have you received the course outline?
No, sir.
No, sir,
we haven't.
Anyone can speak.
No, sir, we haven't received the course outline.
I'm not able to hear you.
No, sir, we haven't received the course outline.
I'm sorry, I'm not able to hear you.
We haven't received.
So we haven't received the course outline.
Can you speak?
Yeah, so we haven't received the course outline.
I'm not able to hear you. Are you able to hear me clearly?
Yes, sir.
Yes, sir, we are.
Yeah, I know. I can see that you are nodding your head, and I understand that you are hearing. I don't know what to do that. Is there any specific setting that I didn't do?
Maybe it's a speaker issue.
So you have not connected with the internet.
Okay,
Call
so
over internet. There is this option wherein you can just go to the mute option.
No, Sapna, I don't think he can hear us, no?
Yeah.
So what's the point? Yeah.
Just a second. Give me a second. Hey, this is Surender. Can you come here? I'm not able to hear the participants' voice. Can you quickly come? Sure, great, thanks. Bear with me. I just asked someone. Right. Yeah, as I mentioned, we will be using whatever we discussed during the orientation program as part of this course. So if you have looked at I don't know whether you have received. I see that you have not yet received. Right. Yeah, wait, Shivam and Hitesh, someone is coming, they will check it, they will look into the details. Right. If you look at the course outline, if you are not received, just, I will ask the PGP office to share with you, or one of you take, just volunteer and ask the PGP office to, share the course outline with you, because I have already shared almost 1 month back with them. So they should be sharing with you if you have not received. If you look at the course outline, you can see that there are 5 modules in the course outline, 5 or 6 modules. Each module is completely, standalone. in the sense that, they kind of provide, so Foundations of Finance course is created, to provide the foundation to all the various functional areas of finance. First module, we will talk about the financial markets. This will provide the basic understanding of financial markets. Then we will discuss about the, performance of securities, means the time value of money, how to value the securities, how to value the bonds, some of these concepts, so that will build into some other course in the future. Okay, then we will talk about the, market efficiency, behavioral finance. That will be basis for the other course. Right, and there's another module on the risk return. Another module on the risk return, where we will discuss about the basics of, portfolio management. Okay, so whatever we discuss in that module will form into the, basics or the foundation for the foundation for the portfolio management course. And we will also discuss in the last module risk management, that will form as the basic for the derivatives and risk management courses that you will study in the, in the second year. So in a way, the Foundations of Finance provides the basic foundation to various courses that we will be studying in the finance specialization. Yeah, can someone speak to me?
Yes, sir.
Yes, great. Thank you. Thank you very much. I'm able to hear. Thank you. Right. Right. I already shared the, have you received the course textbook?
No, sir, we haven't.
No, sir.
You haven't received the course textbook. I have been told that, you wanted the hard copy of the textbook. And I told them the text title almost 20 days before. I don't know, what's happening. I will check.
So we have received the link for the ebook as of now,
Okay, fine, perfect.
until the articles
I
arrive. So
Perfect,
the
perfect.
hard
you can
copy.
access it till
Perfect.
12th of November. Yeah.
Perfect. Your choice of asking for the hard copy constrained me on one aspect, because I wanted to offer you the global edition of the textbook. Okay, global edition of the textbook is not available in the hard copy version. Okay, only Indian version is available through the hard copy version. So problem with the Indian version is that, see, it's only one book. Every country will, one author will adopt that book and use instead of the US example, they use the Indian example. Okay, so you understand. Let's say if a Pakistan edition will have the Pakistan examples and Pakistani author. Okay, similarly, a Brazilian adaptation will have all the three basic authors and the Brazilian author and Brazilian example. So I wanted to have the global edition. Why? Because it's not that I'm not patriotic to have the to have the Indian example. I believe that I can make you familiar with Indian examples, but only there are the Indian author went a little overboard, and instead of using the Cisco, he tried to use he changed the name of Cisco. Instead of Cisco, he used the TCS. Instead of Boeing, he used the Tata Motors. So that's how they changed it. They modified the examples. So what happens is that when you start looking at these examples, you find strange. You look at the numbers that they don't really match to the real Tata Motors and the TCS. There are actually numbers of the Cisco and the US Boeing examples. I'm just giving an example. So I used to get a lot of questions from the students saying that, sir, what are these questions? This is nothing to do with the Tata Motors, but it's saying as a Tata Motor. So I didn't want that kind of embarrassment. When you ask those questions, so I wanted the global edition. And there are the Indian books are available. I still wanted the global edition because, see, financial markets in India, have the history of 30 years. Not more than 30 years, where the US market has been there for the last 100 years. Recorded history we have in the US, from the US market, we have from 1900 onwards. Whereas in India, we have only the last 30 years. Systems are not well developed. As a student, you need to learn. I believe that you need to learn from the best practices. Once you learn from the best practices, you can adapt to the Indian version. What happens is that, if you look at the very nascent example, very undeveloped systems, and if you learn from them, what happens is that you will miss out what are the best practices. Okay, so all these, because we have developed our financial markets by looking at the Western financial markets. So there is no point in learning as a student only the Indian version. Let's learn the global edition, global markets. And wherever applicable, we will look at the Indian examples. So that's how the approach. The textbook is very famous. In all the MBA colleges globally, 80% of the MBA colleges use this textbook. So don't worry about the textbook. It's very difficult to read. It is very difficult to understand. Still, we prefer the textbook because that's what I want you to study. Okay. There is easily written textbooks are available, but I don't want you to study those textbooks because they just read these couple of standard textbooks and write their own versions. So what happens when they write their own versions, if they don't understand the concept clearly, they will have their own version, and when you read, you will have your own version of the concept. So it will get distorted. So that's the reason why I always prefer the global editions for all the courses that I teach. Okay, so it's not that we are not interested in the Indian versions. We are interested in the Indian versions, but it's just that we don't have the right standard textbook in India. At least as far as the finance courses is concerned. Okay, accounting is different. Accounting standards are, well, to some extent greatly developed. I'm okay with accounting textbooks. Okay, right. That's all gossip. Okay, right. So I asked you to read through the lecture notes, very loosely written lecture notes that I shared. By the way, we don't exactly follow the textbook. The textbook is a reference book. I will not be able to teach all the textbook in 20 hours, 25 hours. There's no way I can do that. So whatever the concepts that we study in the course outline, I will reference it to the textbook. And some concepts which are not there in the textbooks, I will give you the lecture notes, my own lecture notes. Okay. So for example, today's session or tomorrow, the next session, we don't have the clear material in the textbook. So I prepared my own the lecture notes that I share it with you. Okay. I gathered this textbook from various places. So that's how we do that. Okay, right. So if you rightly remember, we discussed what is financial market. Financial market is the place where financial assets are traded. Okay, I'm not going to repeat, and what is financial asset, what is a real asset. We are all, aware of it. Financial assets, financial instruments, financial securities, they all are same. Okay, right. And we further discussed about the various functions of financial markets, if you rightly remember. By the way, my the screen will have the half of the PPT off of the whiteboard. That's how the whole course will go. If you have any difficulty, if you have some improvement, I'm ready to adapt, because it's only 5-6 months I've been teaching online. Otherwise, I used to teach the physical classes. So I'm ready to learn. If there is any best practice, I'm ready to adapt. So be open for that. Okay, so be open to offer any suggestion. I'm ready to evaluate with a positive mindset. Okay, right. We discussed about the functions of financial markets. There are various functions we discussed. One is the capital allocation. Financial markets allocate the capital to those people who are in need of money, from those people who are ready to supply. There are two channels. One is the direct channel. Another one is the indirect channel. Indirect channel. So how does the indirect channel, direct and indirect channel means companies which are in need of money, they can go to the financial markets and raise money. So that is through the, either through the IPOs, initial public offers, or the follow-on public offers. This is also called seasoned public offers. Okay, follow means already, companies which are already issued the securities, when they go next time, we call it as a secondary offer, or the seasoned public offer. Okay, follow-on public offer if they needed money, some more money for their investment. So in indirect channel, financial markets facilitated through the mutual funds are essentially through financial institutions. So when I say financial institution, that includes the mutual funds, banks, various things, through financial institutions, financial market facilitate transferring the money from the people who have the access to those people who are ready to deploy those funds. Okay, right. And the another function we discussed about is the risk sharing. Financial markets facilitate the sharing of the risk. Means in a way, financial markets helps the entrepreneur to spread the risk, among the people who are willing to take the risk. How do they adapt? How do they take up the risk? By buying the securities in the company. Okay, so they will anyway. So in a way, financial markets helps in spreading the risk among the people who are willing to take the risk. Okay, that's one of the functions of financial markets. We discussed all these concepts. I'm not going into the details. I'm just, trying to recap whatever we discussed. Okay, right. Another one is the informational role. What is the informational role financial markets adopt? See, financial markets gather the information about the expected performance of the companies. In the sense that if the financial markets, opinion, if the aggregate opinion in the financial market is about the particular company, if the opinion is positive, so the securities of those companies will raise. Because people wanted to, hold those securities. The value of those securities will go up. Okay, so in a way, financial markets, facilitate financial markets, decide, which securities or which companies are going to success in the future, or which companies are going to fail. That's what the information. Financial markets acts as the aggregator of the information. Okay, it's not that financial markets is always wrong, always right. They can be wrong. Collective opinion can become, negated, as the future unfolds sometimes. Okay, but financial markets facilitate the capital to those, investment opportunities that appear at that particular point in time to have the greater prospects. That's what it is. Okay, you need to be clear on that. So financial markets did make the mistakes in the past. They probably making now. They may make in the future. Okay, it's just that they reflect the collective opinion. If the market is going up, so some of you may be thinking that, the pandemic is giving all the negative news, market is continue to go up. What's happening? See, are the markets making mistakes? If everyone thinks that the market is, making the mistakes, market would have not gone up. So, if everyone in the collective opinion in the market is that, we are going to see the rapid increase in the, the profitability or the revenues of the companies. So that's what is reflected. Market price is the reflection of the expected growth opportunities of the companies. Okay, so that's what the market price reflects, because book value reflects what is there in the currently in place. The market prices reflect what is there in the place plus growth opportunities. If the collective opinion in the financial market is that, the particular company has a greater growth opportunities, that growth opportunity concept. So when I say that the price, market price is the reflection of the, assets in place in place plus growth opportunities. Okay, so assets in place, the value of assets in place is nothing but the book value of the equity. So that's how you can understand. Obviously, book values are reported at the historical cost. So I know that you have studied the financial accounting. They may not reflect the exact market value now, but that's what is the value that is available about the assets in place. Okay, that's what so if you want to do fair valuation, so you make it the fair value of assets, but generally they are reported historical costs. You have the conservative principles, so you might have studied all these concepts. Then we discussed about the types. By the way, there are something known as economic functions. What are the economic functions of financial market? Price discovery, okay, and the liquidity and the efficiency. What is the liquidity? I mean by liquidity is here. What I mean by liquidity in the financial market is ability to sell a given quantity of a particular security, at the prevailing prices. If your quantity of your purchase or sale decision influences the price, it means that the particular security doesn't have enough liquidity in the market. Okay, so what do I mean by that? If I, if the Shivam wanted to sell, 1 lakh shares of Infosys, he can sell 1 lakh shares of Infosys at the current market price, because for Infosys there is enough amount of volume is being traded currently. If I assume that he is holding the, the UCAL Fuels Limited, or the Balrampur Chini, it's a Balrampur Chini is a company. If he's holding the 1 lakh shares of Balrampur Chini, if he wanted to sell, the moment he sells, if there is not enough liquidity, the prices immediately will go down, because he wanted to sell, because there is a sudden, dumping of 1 lakh shares in the market. Since there is not enough demand in the market, the prices will depress. It means that Balrampur Chini security doesn't have enough liquidity in the financial markets. So that this is what I mean by liquidity when I say liquidity in the financial markets. Okay, right. And the price discovery we have discussed, financial markets, facilitate the discovery of the price of the financial securities. Efficiency, it means that the financial markets brings the people who are wanted to supply the capital to and the people who wanted to demand the capital to the one place. In a way, financial market reduce the search costs or transaction costs. So that's what I mean by the efficiency. Okay, these are the functions of financial markets. And the types of financial markets, how do we classify, the financial market? There are various ways to classify the financial markets. The one way to classify the financial markets is based on the nature of the claims. By the way, what is financial asset? Financial asset or financial security is it reflects or it represents a claim on the cash flows. Okay, if the nature of the claim is fixed nature, the market where those assets are traded is known as a fixed income market. If the nature of the claim is residual nature, the market where those residual claims are traded, assets representing the residual claims are traded, is known as a common stock market. Okay, based on the nature of claim. Nature of claim. Okay, we can classify. One is the fixed income market, the another one is the common stock market. And based on the maturity of the claims, if the claims are going to mature within 1 year, we call it as a money market. If the maturity of the claims is more than 1 year, we call it as the capital market. Okay, right. We have discussed this. Another one is whether the securities are newly issued or already securities are trading. If the securities are newly issued, the market where the securities are newly issued is known as a primary market. Already securities are traded, market where already securities are traded is known as the secondary market. We know that. Based on the organization structure, also we can classify over-the-counter market. The another one is the what's the another one? Over-the-counter market and the exchange market. Okay, auction market. Auction market and over-the-counter market. Auction markets are completely replaced now. We don't have any auction market. What we have is the over-the-counter market and the exchange market. Exchange market is the place where the standard products will trade. Over-the-counter market where the customized products will trade. Okay, right. So we will study, as we go along, what do you mean by customization of the products? What is standardization? These issues you will study as we prolong, as we go ahead with this course. Okay, further, who are the players in financial markets? We discussed, households, they are generally net savers. The companies, they are the net borrowers. Government also participates in the financial markets. Financial institutions also participate in the financial markets. Generally corporations do not participate in the financial markets directly because they don't have, say, you call fuels, that is into the auto ancillaries. They manufacture the, what is that, fuel filters. So their management is not equipped to deal with the financial markets. What do they do when they wanted to raise the money? They approach the investment bankers. So investment bank acts as the representative of the UCAL Fuels Limited in the financial markets. Okay, that's how it happens. Okay, right. The recent trends we discussed, globalization, how the globalization has changed the nature of the functioning of the financial markets, securitization, various products that are being created, and the information technology, how it has improvised the trading mechanisms and the information dissemination. So these issues we have already discussed. Okay, so now in the today's session, I just wanted to kickstart discussing about the financial instruments. How do we read the quotes in the financial markets? What are the financial instruments? So briefly, I wanted to introduce, the financial instruments. Okay, this is what we have already looked at. The recent trends, globalization, computer network, securitization, financial engineering, the synthesizing the new products, combining the various products, and make the, another product. So this is what is the basic introduction to the financial markets. But what I wanted to discuss today, start discussing today, is the financial instruments. Okay, we know that based on the nature of maturity of the claims, financial markets can be classified as a money market, and the another one is the capital market. By the way, see, if I say money market and capital markets, okay, let me make some more distinction here.
Hello, sir.
Yes, sir. Go ahead.
Yeah, sir. This is Shivam here. Sir, I had a query regarding that Balrampur Chini case that you just discussed.
Go ahead.
Yeah. So I wanted to ask whether the converse is also true. If there was enough demand in the market for its shares, and so the prices wouldn't have dipped, right?
Right. So we say that particular security has enough liquidity. Enough liquidity. See, the moment your transaction depresses the price, or if the moment your transaction influences the price, so it means that security doesn't have enough liquidity in the market. See, if you want to sell, prices will depress. If you want to buy, prices will go up. See, if your transaction influences the prevailing price, that shows that, to what extent it gets influenced. The price gets influenced. If price gets influenced to a larger extent, it means that the security doesn't have the enough liquidity. Okay, if it doesn't get influenced at all, it means that the security has enough liquidity in the market. Okay, that's what, my meaning of our understanding of the liquidity in the financial markets. See, you might have studied the concept of liquidity in the accounting. Accounting concept of liquidity is the ability to convert the assets into the cash. So I don't want you to get confused with that. That is the liquidity in terms of the, how accounting assets are converted into the cash. But what I mean by liquidity in the financial markets is ability to sell or buy a given quantity of a security at the prevailing price.
So could I ask a question, please?
Yeah, go ahead.
Yes, sir. So in the document that you had shared, it's given that debt instrument is liquidated when it matures. I completely understand.
Right.
And equity instrument has to be held until the company is liquidated. What is the meaning of that?
Oh,
The equity instrument
equity, there is no maturity for the, company is the perpetual entity.
Absolutely.
It's a going concern. In a way, the equity securities doesn't have any final timeline. It doesn't mature. It only gets matured when the company completely winds up. As long as company runs, you have the claim on the cash flows company provides, and you have the voting right. Okay, until it completely liquidates itself and distributes the proceeds, then till then you have the claim on the company cash flows and the voting right on the company. Whatever you are entitled. Okay, so in a way, equity securities have the perpetual lives. Okay, but of course you can liquidate. You can liquidate your position by selling. You can transfer your ownership to someone else. But that ownership, that particular security continues to be there. Existence either in my hand or in your hand. It doesn't get completely matured or it doesn't get vanished. Okay, yeah, there is a way companies force the vanishing of some of the securities by buying back those securities. When the company buys back some of the equity securities in India, okay, you asked me the right question, the relevant question. Nowadays, you can see that a lot of IT companies are buying back the securities. You may be reading that, whenever, last 2-3 years, I can say that TCS has been buying back, the securities because they have accumulated the cash, so much cash on their books. Investors are getting somewhat confused or somewhat worried. These guys are accumulating the cash and not distributing to the shareholders. They are worried that managers may misuse that cash. You understand? Managers, see, company, whose company is that? Shareholders' company. Managers are just employees. They may miss, if they have too much cash on their banks. They may go for their board meetings in the in a luxurious beach resort. They conduct they may take all the board of directors to the Thailand or the Indonesia to conduct the board meeting. Which doesn't add any value to the company because they have the money to do that. These guys are a little worried. Or they may invest in the projects where those projects may not add value to the company. They may be pet projects of the CEOs. So generally shareholders are really worried. What will happen to our money? So previously they used to say that, when they start accumulating, they used to inform the board, the shareholders, saying that, we may have a lot of growth opportunities, inorganic growth opportunities. So we wanted the cash back so that as and when opportunities comes up, we will immediately acquire them. Okay, and they used to give the justification of this justification for the cash pile. But last 5 years, you can see in the Indian IT industry, not many acquisitions happen. Okay, so that justification is not being, subscribed by the shareholders now anymore. They are not believing that. You are saying that you are not buying anything. Why are you still accumulating the cash? Why don't you distribute? So there is a pressure on the management or board of directors to distribute the money. Okay, and you will, at some point, you will understand that, in what ways to distribute. If the company wanted to distribute the money, what are the ways to distribute? So you will understand, at latter point in this course or the next course, you will understand that the best option that they have now is the buying back the securities. If the company buys back some securities, what happens? Whatever the bought back securities, they will cease to exist. The moment company buys back those securities, they need to extinguish those securities immediately. Okay, let's say before the buyback, let's say there are the 1 lakh shares outstanding. Now they are bought by the 220,000 shares. Now after the buying back, successful completion of those buying back, you will have the 80,000 shares outstanding. Okay, but in a way, and only either those securities will cease to exist. The buying back, our company completely dissolves itself. Okay, until then there is the existence of that equity security.
Sure, sir. Thank you so much.
Right. Yeah, that's right. You need to force the discussion. That's how you learn. Otherwise, I will become a little monotonous. To talk about what is there in the slides. Okay, you understand, because it's not the physical classroom where I can see the, I can observe few of the facial expressions and understand that whether you are following the concept or not. But otherwise, I cannot throw the too many examples until you force me to do that. Okay, so that's what you need to take the responsibility, your own responsibility for your own learning, right? Based on the maturity of the claims, we can classify the financial markets into the money market and the capital market. Just imagine if the maturity is less than 1 year. What do you think the nature of those securities? Can the equity securities have the 1 year maturity? No.
No, sir.
So can I say money market is a subset of the fixed income market? Because all the money market securities have the 1 year maturity. And I can't say that money market is a fixed income market, because there is many bonds which are the more than 1 year. So I can say that, money market is a subset of the fixed income market. Okay, right. And another market is the capital market. So capital market includes the bond market, means fixed income market with a more than 1 year maturity. Another one is a common stock market. So we will try to understand the various instruments that are available in the money market, bond market, and common stock market. And how do we understand their codes? That's what we are going to spend some time in understanding. Okay, right. Yeah, this is what I have. Money market is a subset of fixed income market. They usually, by the way, trade in the large denominations. So usually out of reach to the individual or normal the investor. Okay, generally companies do invest in the money market. Of course, individual can also invest. The minimum transaction, or the minimum transaction that you need to have is I don't know, close to the 10 lakhs. So what happens? They are usually out of reach to the individual investors. Now Indian government is making the changes so that to allow the individual investors to invest in the money market instruments. Okay, money market securities with less than 1 year maturity. Okay, but individuals can get the exposure to the money market instruments by buying the mutual funds that invest in the money market instruments. So you can get the exposure to that. So through the mutual funds, right? Through money market mutual funds, small investors can purchase the securities. By the way, what are the instruments that are available in the money market with a less than 1 year maturity? Can you think of
Treasury bills.
Yeah, that's what is written there. Money market.
Commercial papers.
E-bills.
Certificate
Notes.
of deposits.
CPs, CDs. Certificates of deposits, right?
Yeah.
Right. Anything else that you can think?
Papers.
Commercial paper, CPs have written here. Anything else you can think of? Money market instruments. By the way, these are the popular money market instruments that you have mentioned. Is there any other money market instruments that anyone is aware of? Money market instrument that I'm talking about. It's anything less than 1 year maturity that falls into the money market. Okay, right. There are various instruments that we will talk about it. Okay, the popular money market instrument is a T-bill, treasury bills. Issued by the governments. Of course, governments do not issue directly. Governments issue through their central bank. Indian government raises the short-term capital by issuing the T-bills through the RBI. Okay, so every government issues through their central bank. Okay, these are known as the T-bills. So in US and in India, in US T-bills are issued with the 28-day maturities, 91-day maturities, 182-day maturities. But in India, we have the almost 1 year maturity also, 364-day maturity also. Okay, so they every with the frequency of 15 days, I think every Wednesday in India, the RBI auctions the T-bills. The people who wanted to buy the T-bills, they will go and buy T-bills. Generally, banks will buy the big financial institutions buy in the auctions, and they will again sell it to the people who are ready to invest in the T-bills. That's what happens. But how do we yeah. By the way, income on these are the government instruments. Income on the T-bills are exempt for any tax purposes. Yeah. By the way, T-bills are not quoted in terms of the prices. By the way, let me tell you, a T-bill which is going to mature in 90 days, you are standing here, 91 days, which is going to mature in 90, you are standing here at time 0. This is what you are, and 91 days is going to mature. Say, it has a face value of 1,000. How much will you pay for this security today? Can you think? Will you pay 1,000? See, a T-bill which is going to mature in 91 days with a face value of 1,000 means it will pay at the end of the 91 days, it will pay you 1,000. Okay, how much will you pay this for the security? Less than 1,000.
Less than 1,000.
Yeah, of course, it's a less than 1,000. So generally, how much is less than? So they will trade a discount to the face value. You understand? So they trade a discount to the face value. All the T-bills in the market, they trade discount to the face value. Okay, right. And they are quoted in the market not in terms of the price. They are quoted in terms of the annualized discount rate. So you don't need to write down the things, I will give you all the material, try to understand the concept, you will have all the material. Okay. I don't want you to miss out, So they are traded at the annualized discount rate. Nowhere people quote, it is trading at 950 rupees. They don't say it's trading at 950 rupees. They say that what is the annualized discount rate. Okay. So, okay. How do we value those securities? Just, they are quoted in terms of the annualized discount rate. Let's say, a T-bill maturing in 90 days, with a face value of 1,000, let's say it's a face value of 1,000, and it is trading at the 4.5% discount, annualized discount rate of. So what they will say that a T-bill with the 90 days with a face value of 1,000, it's trading at the 4.5% annualized discount yield of 4. Annualized discount rate, people call it as an annualized discount yield. Okay, it is trading at the 4.5%. Now, at what price you will buy this security? Can you think of? See, it's a T-bill which is going to mature in 90 days. Okay, and it is quoted as a 4.5%. What is 4.5%? It's an annualized discount rate. Now, how much money you need to pay to buy the security?
955.
How do you? This is the annualized discount rate, but maturity is 40 days here. I understand you are right. So now we need to know what is the face value, what is the value of the security, right? What is the price? Price is nothing but, face value. Face value in this case is 1,000. Face value into the 1 minus annualized discount rate into, okay, just, and the number of days to maturity. Upon the, we use the 360-day year convention. I will tell you why we use this. It's a convention. Okay, we use a 360-day. All the T-bills prices are quoted using the 360-day year convention. We use the 360-day year convention. So this convention is also known as the bank discount method. You may say that, why they are having this convention? Why can't they use the 365-day convention? This is just a convention. There is no scientific really a logic why they are not using. This has been the practice. It is being in the practice. Okay, so as long as you know how they are calculated, it's that's fine. There's nothing inefficient there. Okay, right. So at what price you will buy now? If to calculate the the T-bill, so they are quoted in terms of the 4.5% annualized discount rate. So you need to calculate. What is the price you need to pay? Let's say, assume that tomorrow you join a company, you are working for a CFO, you are associate for a CFO. And the CFO says that, we have the 40 lakhs rupees. Now we don't need this 40 lakhs rupees. If we keep this 40 lakhs rupees in the current account, we don't earn any interest. We need this money only after 3 months, after 90 days. Okay, then he will say that, what you need to do, you need to speak to your corporate banker and you need to say that, give me the quotes for the T-bills. And he will not tell you the money. He will tell you these quotes. You should be able to convert it to the price and transfer the money to buy how many bills to be bought. Okay, of course, if you say that I'm illiterate, you can ask that, you tell me the price. I can't read this. That's a different aspect. But you should be able to read those quotes. Okay, so now in this case, at what price? 1,000 the into the 1 minus 0.045 into 90 by 360. This is the price that you need to pay. Yeah, can someone calculate? By the way, everyone should be holding the calculator next to you.
So 238.75.
How much, man?
So 238.75.
No, it should not be so low.
988.75.
988.75.
Yes.
I've not calculated, someone can cross check. This it means that you need to pay at this price. And by the way, T-bills are issued by the government. They don't generally default. There is very risk-free, almost risk-free security. Okay, because there won't be much default happening with these securities. Okay, right. Right. If you buy, by the way, one more thing here. One more thing you need to understand here. If you buy this T-bill, so essentially you need to pay at time 0. You are standing here. You need to pay 988.75. At the end, 90 days, you will get 1,000. This is what is annualized discount rate. Now, if you buy this bond, T-bill is a short-term bond, essentially, zero coupon bond. It doesn't pay any coupon. Okay. Now, if you buy this bond hold till maturity, how much yield you are getting? Okay, how much yield you are getting? So, you are getting 1,000. How much you invested? 988.75 and 988.75 into, you need to, this is 3 months, right? You need to convert into the annualized yield. How do you convert? So yields are converted. Yields are calculated using the 365-day year convention. Prices are calculated using the 360-day year convention. Yields are calculated in the market using the 365-day year convention. So you need to be aware of. These are the conventions that you need to be aware of. All the money market instruments are quoted. Money market T-bills are quoted with the annualized discount rates. Prices are calculated using the 360-day year convention. That method is known as the bank discount method. When we have to convert into the yields, we calculate using the 365-day year convention. This 365-day year convention is known as the bond equivalent yield method. Bond equivalent yield method. Okay, these are the conventions. Okay, right. Right. I have the material. Just don't worry. Right. That's right. Now just look at here to understand this. A T-bill maturing in 90 days is trading at 4.9%. 4.9% is the annualized discount rate. That's how they say. The face value is 1,000. So calculate its actual price in rupee terms. How do we calculate? This is how we calculate. Okay. Just look at here. So it is trading at the 987.75 rupees. Okay. They are quoted in the annualized discount rates. So prices are okay. So 360. This 360-day year convention is known as the bank discount method. It is known as the bank discount method. Okay. Now, see, sometime back, not now. It's last year. When I was teaching this course for someone else. So I spoke to one of my friend who is working as in the corporate banking division. Okay. I asked him the T-bill quotes on that particular day. By the way, banks will buy these T-bills from in the auction from the RBI, and they will sell it to the corporates whenever they want it and buy them back. They act as a dealers. What do you mean by the dealer? They buy whenever someone wanted to sell. They sell whenever someone wanted to buy. Okay, these are the quotes he has given. Exactly this table he has given as on the 31st August 2019. Okay, so just look at here. So this 48-day T-bill is going to mature in the. Assume that you are standing on the 31st August 2019. For the illustration purpose. So these are the quotes he has given. Just try to understand. He is a dealer. He works for the ICICI Corporate Banking Division. He has given these quotes to me. Similar quotes he generally gives to the corporates who wanted to park their excess cash that they are holding now. Okay, so these are the quotes he has given. Now just try to understand the terminology here. What is a bid? Bid is the price at which someone is ready to buy. Okay, the ask is that he is ready to accept to sell the security. That's what is the bid and ask. If you wanted to buy, at what price you will buy? See, he has given his bid and ask. He is ready to buy at bid. He is ready to sell at the ask. You understand? Generally he will buy at the higher discount, sell at the lower discount. So that is the spread is the commission for him. Okay, you try to understand. He will buy at the higher discount, means lower price, sell at the lower discount. Okay, you try to understand the concept here. Now these are the dealer codes. If you wanted to buy, assume that you wanted to buy the 90-day T-bill, at what code, at what price you will buy, at what rate you will buy?
4.91, because that is the quote he's ready to sell it at.
No, 4.91 is the quote he wanted to buy. That's a bid. He wanted to sell it at what? 4.9. You try to understand. These are not your quotes. These are the dealer quotes. You try to understand. He's the dealer quote. He wanted to buy at bid, sell at the ask. If you wanted to buy, you can only buy where he can sell, right?
So at 4.9.
Right.
Yeah.
Right. So assume that the T-bill has the face value of 25,000. Now, at what price you will buy? You can calculate now. Now let's understand here. Let's understand that the face value is, let's say face value of the T-bill is 25,000. Now, what is the bid price? Can someone tell me what is the bid price he is ready to buy? What is the ask price he is ready to sell? And you can buy at the ask price. You try to understand. You can, because he is ready to sell, so that at that price you will be able to buy. Okay, so that's what is the quote. That's how you should read ask. So what are these prices for this T-bill? How do you calculate?
So 24,693.125 is the bid rate.
24,693.125.
125
is the bid, is it?
Yeah.
Ask is, how much is the ask?
24,693.75.
24,693.75. So just look at here. He's ready to sell at the higher price and buy at the lower. So the difference is the margin he will have. Okay, that is known as a bid ask spread. That is a spread that is known as the bid ask spread. So since these T-bills are highly traded, the bid ask spread is lower. If they don't trade so frequently, what happens? They need the higher commission. The spread will be higher. Okay, so that's how you need to read the T-bills. Okay, so T-bills are, just try to understand, T-bills are quoted using the annualized discount yields, and we convert those yields into the prices using the bank discount method, which is 360-day year convention. Okay, if you buy the T-bill and hold till maturity, if you want to convert into the yield, you convert into the yield using the bond equivalent method, that is known as a 365-day year convention. Don't get confused. These are the basic things here. T-bills are, we buy at the discount. That rate is known as the annualized discount. To convert the rates into this annualized discount rate into the prices, we use the 360-day year convention. Okay. Yeah. Right. Right. If you have any question, you should ask right away, because we will keep on building on these things. These are the basic things. You should be clear on these terms. Right.
So is bid ask spread the difference between both bid and ask prices?
Right. You're right. That's a difference between the bid ask price. If you wanted in terms of the yield, you can see the difference here directly, 0.01%. Okay, if you want in terms of the price, you can convert it to the price and see what is the difference. Okay, see, spread can be expressed.
What is this 5.03% yield?
Oh, 5. Okay, yeah, I'm coming to that. So by the way, I'm sorry, I erased it. What is the ask price? Someone was mentioning ask price.
24,693.75.
Just a second here. Sorry, I missed it. Right,
693.75.
See, you can buy at this price, right? And hold till maturity. How much you will get? 25,000. Right. So now yield is calculated 25,000 in minus. This is minus into the so minus 24,693.75 upon the. This is what yield actually. This 24,693.75 into the 365 upon the 90 will give you the 5.03%. That is what is asking. That is what is asking. Generally, some of the banks don't give the asking. some banks do give the ask yield, but if they don't give, you can calculate. If they give, you can see that. Okay, but this is how they calculate the ask yield. Okay, so this 365-day year convention is known as the bond equivalent yield method. So I explained here what is bid and what is asked. You can read later, right? Same thing I mentioned here. So this is known as the actual yield if purchased and hold till maturity is conventionally annualized using the 365-day year convention, which is known as the bond equivalent yield method. Okay, this is what it is. Okay, right. Yeah, I've given one example. I don't want to take you through another example. You can try it out. I want you to calculate the T-bill prices, bid-ask prices for the 55-day bill. 55-day bill is the this one, which is going to mature on 25th October 2019. 4.83 is the bid price, and the ask quote is the 4.82. You can just try it out. I don't have the answer here, but you can calculate. Okay, right. Okay, let's move on. That's all about the T-bills. Now you know how to read the T-bill quotes. Okay, how to convert it to the prices, how to everything about almost everything about the T-bills. T-bills are issued by the treasuries. These are treasury securities. They are usually risk-free securities. Risk-free in terms of the default. Government usually do not default. Okay, so another the popular money market instrument that you mentioned is the certificates of deposit. Yes, sir. Yes.
Sir, T-bill is issued by central government or is it issued by state government?
Central governments. Treasuries. Treasury issues. Central government bonds are known as the local government bonds. I will come back to that. What kind of bonds the local governments do issue, we will discuss, either today or next class. I have some material, to discuss about that. We call it as the local government bonds. Okay, some local government could be the state government, it could be the municipal government. Okay, in India we don't see any municipal governments to issue, but nowadays you see a lot of state governments issuing the bonds. We will talk
local
about
bonds. Yes,
local government bonds. We call them as a local government bonds. Okay, right. We will try to understand. I don't promise that we will understand all the instruments in the financial markets, but you will have the working knowledge. To read the various codes in the financial markets. Okay, right. Yeah, another popular instruments in the money market is the certificates of deposits. What is the certificates of deposit? There are two instruments actually. Certificates you may get confused, mostly with the certificates of deposits and the what is this? Yeah, so there is something known as the CPs, commercial papers, versus the CDs. So let's understand, let's clarify what is the difference between them. Certificates of commercial papers are issued by the corporations. Corporations. And the CDs are issued by the financial institutions. That's a basic difference. Okay, both are unsecured instruments. These both are short-term instruments. Both are unsecured. Both are unsecured. But they are not backed by any asset. Unsecured. That's what I mean by. And both are short-term instruments. Of course, we are discussing about the money market. I don't need to write it there. Okay. Now you need to understand commercial papers are issued by the corporations. They are of the less than 1 year maturity. By the way, they also when you buy this commercial paper, and at the end of the maturity you will get the face value. Since you get the face value at the end of the maturity and you don't get anything in between, so the price you pay will be less than the face value. Say you are standing here and this is the maturity time, you will get the face value. So how much price you will pay? You will pay less than the face value. So all the CPs and the CDs also similar to this. They trade at the discount to the face value, and they also quoted as the annualized discount rates. The same way as they are quoted in the case of the T-bills. The quotes are same way they are quoted. Price is converted into using the bond equivalent yield method. Yields are converted using the bond equivalent yield method. 365-day year. Okay, so they also trade at the discount to the face value. Almost all the money market instruments, because they don't pay any coupon payment and they only pay the face value, they trade at the discount to the face value. And they are not quoted in terms of the prices, they are quoted in terms of the annualized discount yields. And annualized discount yields are converted into the prices using the 360-day year convention. That's all. So let's take away that confusion from the picture. Okay, all the money market instruments are trading at the annualized discount yields. Okay, right. Okay, so the difference is the commercial papers are issued by the corporations, CDs are issued by the financial institution. So it means that a financial institution which is in need of the short-term capital will go to the financial markets and raise money from the financial markets by issuing the certificates of deposits. So now the question is that what is the difference between the certificates of deposits and fixed deposits? See, banks do issue the certificates of deposits. They go raise money from so they issue the paper. So people who subscribe the paper, the certificates of deposit will pay money, and that money is used by the bank whenever they need a short-term capital. So how is it different from the fixed deposits? The only thing is that certificates of deposits, let's say you buy the certificate of deposit. Assume that HDFC Bank came to the market and raised money by issuing the certificates of deposits. You can sell it to someone else. Whereas the fixed deposits, not negotiable, not tradable. If you have invested in the bank, you have to go to the bank to redeem it, right? So when it comes to the certificates of deposits, they are negotiable, means they are tradable in the market. Okay, so when you ask the as a treasury manager, as the associate to the CFO or the CFO, if you wanted to deploy or if you want to park some of your money in the money market instruments, you ask the quotes. The guy who gives the quotes, they not only give the T-bill quotes, they also give the CDs quotes, CEPs quotes that are available. You can buy and sell whenever you want it to sell. They are negotiable in the market. Okay, right. And usually financial institutions are highly regulated. Highly regulated. They are expected to follow certain provisions and certain norms. So they are not very risky, but corporations are very risky. So, and these are unsecured. Now just imagine corporations can default in the sense that they are risky, means they can default. And these instruments are unsecured instruments. Now just imagine what kind of corporations can issue the commercial papers. Anyone can issue the commercial papers, but which company's commercial papers you would like to subscribe?
Blue chip companies.
What do you mean by blue chip company?
The companies
The
which are
public listed companies.
Yeah, there are many public listed companies. All the public listed companies
people can
are
trust on companies. People can, they have a record. They have a record. They have a rating.
The company is highly rated. Of course, having rating means even BBB is also rating. AAA is also rated. Only the highly rated companies' commercial papers are subscribed in the market. Means the companies like RIL or L&T, they issue, because they are AAA rated companies. Whenever they issue the certificates of commercial papers, people do subscribe because they are unsecured instruments. You need to understand, because they are not backed by any collateral. Okay, so you need to be clear on that. So okay, let's go back to our slides quickly. Yeah, as I mentioned, it's almost like certificate of deposit. It's almost like a time deposit. The bank pays the face value. They are negotiable because they can be transferred to another individual. They are issued at the discount to the face value. The commercial papers we already discussed. Well-known, highly rated companies often issue their short-term unsecured debt notes. These are the borrowed debt notes. These are the bonds. These are the short-term bonds. Commercial papers. Only highly rated companies can issue. Okay, commercial papers. The maturity of period of the commercial paper ranges between the 15 days to the 1 year in US. Yeah, it is up to in India up to 1 year. In US, it's up to 270 days. Right, like the CPs are issued at the face value. That's all it is. Okay. The another popular the money market instrument is the bankers' acceptances. What is this bankers' acceptances? These are known as, actually, they are highly used in the international trade. Assume that Balrampur chili, since I gave that example, they manufacture what is known as the sugar. If they sell sugar to a British confectionaries, British confectionaries, the UK company, what happens when they sell the sugar to the UK company? Generally, the moment they receive the sugar, they don't pay the cash. Okay, they pay, as per the industry standards, they pay after 120 days. Okay, what happens if it is, but Balrampur chini will be a little worried, because it's not an Indian company. Your customer is not an Indian company. If they default, enforcing the UK law is very headache. Headache in the sense that dealing with them will become a challenge. Okay, so what do they say that we are ready to, export the, 2 metric tons or 20 metric tons of sugar, but provided we are okay for 120 days, but I will not come to you for the money. You tell your banker that he will pay after 120 days. If his banker says that we are ready to pay after 120 days, I will transfer. If that banker, let's say, so British confectionaries will go to its bank and say that issue a banker's, check, a banker's acceptances. If banker says that irrespective of whether, you don't need to ask the British confectionaries, I am ready to pay you after 120 days, whatever is the consideration. So the moment the banker says accepted, so that note is known as a banker's acceptance. So now Balrampur Chini need not to wait for the 120 days. If it needs the money, it can go and sell that check to someone else. So these bankers' acceptances are traded in the market. Of course, if it is, let's say, if it is worth of the, let's say, 2 million sterling pounds, and that is going to get encashed after 120 days. So what happens if you sell it now? You don't get the, same amount. You will get a little less amount. So they trade at the discount to the face value. Okay, these are, people use with various names, but these are known as the bankers' acceptances. Or it's like a, it's a banker's check, post-dated check that you are going to receive money after something. But these are known as the bankers' acceptances. The same thing I explained. They are issued widely in the foreign trade, but the creditworthiness of one trader is unknown to the trading partner. Okay, so these also trade in the money market. Another one is another popular instrument is the euro dollars. Euro dollars are the short-term bonds. Okay, if any company with the international transactions, if they issue the dollar-denominated short-term bonds in the international market, if they wanted to borrow in dollars, if they issue the dollar-denominated bonds, those dollar-denominated bonds are usually issued. They used to be issued only in the European markets. Since they are dollar-denominated issue in the European markets, the name is euro dollars. But nowadays, these short-term dollar-denominated bonds are issued all over the world. But still, the name continues because previously it was issued only in the European market. Hence, its name is euro dollar. Okay, now they are issued in Hong Kong, they are issued in the Japanese market, they are issued in the Canada, various various markets, Singapore, they are issued in the various markets, but still people call it as a euro dollar. The short-term dollar-denominated loans, okay, are the euro dollars. They are also money market instruments. Of course, they also trade at the discount to the face values. Okay, they are being issued all over the world, Singapore, Hong Kong, Japan, Canada, but still the name is euro dollars. Okay, so these are some of the popular instruments in the money market. The significant part of the money market is the repurchase market. Okay, so you might be hearing quite often whenever the RBI is changing the monetary policy, you are going to hear this word called repo rate or reverse repo rate. What is this repo rate?
So repo rate is the rate
at which the RBI.
Okay, let's have a respect. If one starts, others need to be keeping quiet. Okay, yeah, go ahead, Hitesh.
So repo rate is the rate at which RBI lends money to the banks, and reverse repo rate is when.
Hold on, Hitesh. What is bank rate then?
Sorry, sir.
What is bank rate?
Bank credit.
Bank rate.
Bank. So as in, if I have the bank needs 100 crores. And they ask RBI to give them 100 crores, so they give them at a repo rate of 4.5%.
Okay.
And if they need to return the extra money back to them, then they'll give it as we can give it a reverse repo rate of 4.5%.
Hitesh, to some extent you are correct, but you are just beating around.
Sir, I believe.
Hold on. No, hold on. Yeah, just pay attention. So there is something known as a bank rate, there is something known as a repo rate, and there is something known as a reverse repo rate. Right? Whatever the Hitesh given, the explanation is bank rate. Is a rate at which commercial banks borrow from the central bank. Okay, and so what is the bank rate today? As it stands today, 4.25%. Repo rate is 4%. What is this repo rate?
Reduce short.
The banks, in this, the banks have to sell their securities to the central bank.
That's right. That's a Shiva. Yeah, whatever Shiva may say, see, what happens is in the repo rate, actually, it's a repurchase rate. That's what is the short name is the repo rate, repurchase rate. So what do? So central bank, a commercial bank, which is in need of the short-term capital, overnight capital. What does it do? It goes to the central bank and sell the government securities it's already holding, with an agreement that it will buy back those securities at slightly higher price. What's happening in this transaction? A commercial bank or a financial institution which is in need of the short-term capital will go to the central bank and sell the government securities it's already holding and take the money with an agreement that they are going to buy them back those securities at a slightly higher price. Okay, essentially what is happening? You are surrendering your government securities and you are going to take away by paying the money at a slightly higher rate. That rate is known as a repurchase rate. So this has a security, in the case of the bank rate, you don't have the loans doesn't have any security. In the case of the repurchase rate, you have the security. So essentially you are surrendering securities and taking the 1-day loan or 2-day loan. Well, that's what, since it is secured by the government securities, its rate is lower, 4%. Whereas the bank rate is the commercial banks at the rate at which commercial banks borrow from the central bank without offering any security. So that rate is slightly higher. If you offer the securities, it's essentially selling the security with an agreement to buy them back. Okay, so that's what is known as the repurchase rate. Okay, right. And what is the exact mirror image of the repurchase rate is the reverse repurchase rate. Now, I don't want to explain this. You can think of. So in the case of the repurchase rate, the banks which are in need of the short-term capital will go to the financial market and sell the securities with an agreement to buy them back. That's what is known as the repurchase rate. Okay. So what is the mirror image of it? What is the reverse repo?
Financial market will sell their whatever.
Yeah, see, in the case of the repurchase rate, you sell with an agreement to buy them back. Here, you buy with an agreement that sells them back at the slightly higher price. So essentially, you buy the securities and park your money and sell those things with a slightly higher rate. That is what known as the reverse repurchase rate. But why do they buy the government securities? Because all the banks need to manage the SLR, statutory liquidity ratio. So as per the SLR, you can't keep all the money. Some money you need to keep in terms of the government securities. So so sometimes every day you need to manage these ratios. Okay, if on a particular day you are short of the government securities, you can buy with an agreement to sell them back after a slightly higher rate, from the central bank. That is what is known as the reverse repo rate. Okay, so that's precisely is the explanation, right? Yeah, reverse repo transaction, securities are purchased with a commitment to sell them back at a slightly higher price. Okay, right. Yeah, and quickly about the interbank call money market. It's also part of the money market. Quickly, what do we know about the interbank call money market? Generally, the loans are generally only financial institutions participate in the interbank call money market. The loans are up to 14 days. Usually, overnight borrowing. Okay, but they can be extended for the 14 days. Okay, right. We have the various rates that are available. LIBOR. What is LIBOR?
London Interbank Offer Rate.
London Interbank. So what is this rate about? Can we talk about this? Few more things about the LIBOR. Of course, you have explained it. You have expanded this term, LIBOR, London Interbank Offer Rate. It is the rate at which the banks headquartered in London, borrow and lend among themselves. Okay, this is the rate at which they borrow and lend among themselves overnight basis. Okay, and these loans are in dollar denomination. The loans are in dollar, even though the banks are headquartered in London. The loans are not in sterling pounds. The loans are in terms of the dollar denominated. Sorry, denominated loans. Okay, yeah. What else we know about the LIBOR? Quickly. Yeah, this is the London interbank offered rate. The banks headquartered in all the premier banks headquartered in. So what happens? There are many banks headquartered in the London. Okay, so whenever they borrow and lend among themselves, so every 3 months or 4 months, one bank acts as a nodal agency. They will collect these rates from all the banks and they publish. They take the average of it and publish, weighted average of it and publish. This is known as the LIBOR. Okay, right. And they are on the dollar denomination. Where is it? Why is it popular? Why is it popular? So a lot of times what happens, companies borrow at the floating rate. Floating rate bonds. So floating rate bonds, generally the companies specify that we pay, so there is a difference between the fixed rate bonds and floating rate bonds. What is the difference between them? There is something known as a fixed rate bonds.
Floating rate may be accounting inflation into.
Yeah, so they will incorporate the changes in the market fluctuations, for various reasons. The fixed rate bonds, let's say if a company borrows, by promising a coupon payment of 10% on the face value of 1,000, every year it will pay the 10%. That's a fixed till the maturity. Okay, sometimes we may say that I don't want to have a fixed commitment. I know that over the time interest rates are going to go down. Why should I commit the higher rate? So they say that we will pay LIBOR plus 1.5%. Okay, LIBOR is floating. It will change. So if the LIBOR turns out to be 8%, they will pay the 9.5%. If the LIBOR turns out to be 9%, they will pay the 10.5%. So these are, so LIBOR acts for various transactions. It acts as a reference point. So that is what it is. It is very, very famous. Okay, a lot of swap contracts, a lot of derivative contracts use the LIBOR rate as the reference rate. Okay, right. Another money market, another interbank call money market rate is the famous is the Euribor. This is the LIBOR is the London interbank offered rate. This is the European Union's interbank offered rate. The banks, all the banks headquartered in Frankfurt, German capital, Frankfurt. They borrow and lend. This is in terms of this is on the euro denomination, where the LIBOR is in the on the dollar denomination. Okay, yeah. It is not as famous as LIBOR, but in the European Union, this is the reference rate. And we also have the MIBOR. What is this? Mumbai Interbank Offered Rate. This is on the INR denomination. INR denomination. So what happened? But most of the transactions are referenced to the LIBOR. Okay. So what happened? In the 2010. There was some accusations on the people who are managing or publishing the LIBOR, because a lot of transactions are referenced to the LIBOR. Okay, and there was accusation that there's a manipulation that is happening with the LIBOR. Since it is used for for various transactions as a reference rate, so people argued that probably we should not extensively depend on the LIBOR. Most of the transactions are referenced to the LIBOR. Okay, so people started to look for the alternative they wanted to look for any alternative to the LIBOR. Okay, so that is where that situation gave the birth to what is known as the currently becoming famous, which is known as the SOFR. Secured overnight financing rate. Okay, this is published by the Federal Reserve. Okay, now all the international banks are adopting as an alternative rate to the LIBOR. SOFR, they are adopting SOFR as an alternative rate to the LIBOR. Okay, this is known as a SOFR. The Bank of America completely adopted. Bank of America, the Merrill Lynch, they have adopted. Barclays started adopting as an alternative rate. So they started publishing from the April 2018. As an alternative to the LIBOR. So this is also on the dollar denomination loans. Okay, so this is known as the SOFR that is becoming famous these days. The same thing I have here. Yeah, secured overnight financing rate. It is based on the transactions in the repurchase market. Yeah, New York Federal Reserve began publishing this in April 2018. Okay, that's precisely about the money market instruments and the components of money market. Okay, but by the way, all these rates. So which security is more risk-free among these money market instruments? By the way, all the money market instruments. See, the issue is that money market instruments are less than 1 year maturity. Since they are less than 1 year maturity, when you are standing here, let's just imagine when you are standing at time 0, it's going to mature in 1 year, less than 1 year. Okay, what happens when compared to the longer term period maturities? See, the risk perception associated with the short term maturities is lower. Just try to imagine, you are standing at time 0. You will be a little more confident about the possible, the risk associated with the risk associated. Just like this, you are going to get the 1,000 after 1 year. Let's say you are going to get the 1,000 after 2 years. In which case you will be confident about in which case you see more risk.
Second
the
case.
Money that you are right, because generally short-term instruments are having the lesser risk, because you can assess what is going to happen down the line 3 months, down the line 6 months, but it becomes difficult to assess what's going to happen down the line 2 years, 3 years, 4 years. Usually money market instruments are less risky securities when compared to the capital market instruments. Okay, so because as a person, you will be able to assess, you will be able to predict to a greater extent, about the credit worthiness of the other party. Okay, but in the longer term, the assessing the risk perception will be higher. So we can say that when compared to the capital market instruments, money market instruments have the lower risk. Okay, among the money market instrument, which instrument has the lower risk?
Treasury bills.
Treasury bills. Treasury bills are because they are issued by they are backed by the sovereign guarantee. Okay, even though CPs are issued by the highly rated institutions, but they are still the corporations. They are not backed by any sovereign guarantee. Okay, so when compared to the T-bills, commercial papers are traded at the slightly higher discount, because commercial papers are even though they are AAA rated, but they are not backed by the sovereign guarantee. The discount, the price you will pay will be slightly lower when compared to the treasury bills. So the risk is lower in the case of the treasury bills, so they offer the lower returns. Okay, the difference between the return they offer between the commercial papers and the T-bills, the difference is known as the risk premium. If the higher the risk, higher is the premium associated with the instrument. That's what you need to understand. Okay, right. So generally T-bills are considered as the the money market instruments are usually the lower risk, but are not risk-free except the T-bills. Okay. By the way, when I say T-bills risk-free, they are risk-free in terms of the default risk. So because generally government doesn't default. That's what I mean by. Okay, even the highly rated corporations can sometime, but probability of default will be lower, but still there is some positive probability that they can default. Hence, people demand the higher returns when someone wanted to when they invest in the commercial papers. Okay, right.
So can I ask a question?
Sure.
Yes, sir. So I was just wondering if the inflation rate exceeds, say, the discount that is offered or something like that, can we end up losing money?
Of course, you see, okay. You asked me a question. I will come back to that. I will answer at certain point, but let me give an assurance that the rates that are quoted are the nominal rates. Okay. In the financial markets, we deal with the nominal rates. Nominal rates includes the real rate and inflation.
I see. So it incorporates that in the rate itself.
Yeah, that's right. The expected inflation is incorporated. But if suddenly there is a spot in the inflation, over and above your expectations, you will lose the purchasing power.
Okay.
You will still get the nominal rate, but in terms of the number of goods and services that you buy will be lower. You will get the nominal money, but its purchasing power will be lower if the inflation overshoots.
I understand.
Okay, but at this point, just be assured that whatever we are talking about, the rates are the nominal rates.
Sure.
Okay, and we will talk at some point in this course itself. What is the difference between the nominal rate, what is the inflation, what is the real rate. Of course, you are studying the macroeconomics also simultaneously with this course. Okay, you will get the greater insights from the macroeconomics classes on the inflation and its impact on the interest rates. Okay, but as a finance course, but I will at some point will bring that concept into the discussion. Okay,
sure, sir. Thank you.
Right. But yeah, in the financial market, we always talk about the nominal rates. In fact, people in the financial markets say that the real rate is the dreamland of the economists. They generally we don't touch. What we see actually is the nominal rates. What we talk about is the nominal rate. Real rates are actually, we don't deal with the real rate. We experience it. So that's yeah, I understand if the inflation is higher, we may lose in terms of the real rates. Okay, we will talk about it at some point, right? Yeah, the difference between, since the T-bills are risk-free, so all the instruments traded offer the higher returns or trade at the higher discounts. So the difference is known as a risk premium. And this risk premium is expected to be higher whenever there is a crisis in the financial markets. Whenever there's a crisis in the financial markets, all these companies, will become more riskier. Only the sovereign rates will become, more assured. So this risk premiums will be higher, during the crisis periods. So that's what you get to see that. This premium increases during the economic crisis. That's what happens. So I have not covered all the money market instruments. We covered most of the money market instruments. So with this knowledge, you will be able to understand any other instrument that exists in the money market. Okay, right. Right. I'm sorry if we have exceeded the time. Right. It can happen quite often. Okay. So be aware of it. Okay. I still take the 5 more minutes. Okay. So what I thought is that I will discuss about the financial instrument. We still have to discuss a lot of other financial, because we have only covered the money market. We still need to cover the capital markets. We will cover in the next class. But I just wanted to quickly, throw this elephant out about the overview of syllabus. Because yeah. So your first 2 sessions, we will have the 2 or 3 sessions. We will have the financial markets instruments. We will study all these concepts. Then we will study, some of the theoretical foundations, present time value of money, value in bonds and stocks. That has a longer portion, longer time. We will spend some 8 to 9 sessions. We will spend there. That's where we will study interest rates, nominal interest rates, the real interest rates, return concepts, opportunity costs, discount factors. All these issues we will study during these 8-9 sessions. Then a couple of sessions we will have the behavioral finance and the market efficiency. Then we will have the 3 to 4 sessions. We will have the risk return portfolio analysis. That's what we will do. Then we will have the risk management. Okay, where we will study the basics of the derivative instruments. Okay, so that's what is the course outline, right? We are expected to have the 20 sessions, but most often it happens in my courses that we may exceed. So we may go to the 22 sessions or 23 sessions. All the sessions are compulsory. So don't get that, last 3 sessions are, exempted or optional. There's nothing optional here. Okay. And attendance is compulsory. 100% attendance is compulsory. It's a mandatory. If you wanted to miss the session, you don't need to inform me. You inform the TA, teaching assistant. Your PGP rules may follow something. I don't care about them. 100% attendance is compulsory for this course. Okay. If you miss the class, just inform the TA in advance, and you need to have the calculator with you. Not the financial calculator. There are a lot of financial calculator. I want you to know the internal workings of what's happening, because financial calculator acts as a black box. So I wanted you to have the scientific calculator with you. Okay, always, right? And one more thing, grading policy. Yeah, I know that you don't like it, but we need to have the quizzes. By the way, we don't have any surprise quizzes, because quite often whenever I wanted to surprise, I get surprised. So I don't do any surprise quizzes. Okay, just be clear on that. I will announce all the quizzes are announced quizzes. Okay, right. I know that most of you are engineering students, and I know what happens in the engineering students. You have been trying for 4 years, so you will only study whenever there is an exam or any stick. So I will incorporate all those stuff. Okay, so just be assured about it. Yeah, we have the mostly 2 or 3 quizzes. Okay, I will decide upon that. It has a 20% weight. Spreadsheet assignment, Excel-based assignments. All are individual assignment. There's no group assignment in this course. Okay, because it's a very basic course, we don't have any group assignments. Then there will be problem sets at the end of every session. I will share the some problem set that you need to read the chapter and solve the problems, and I will ask you how do you need to submit those problem sets. Okay, I will also share the solution set, so you need to solve the problems and share. And yeah, there will be midterm exam and end term exam. For all the sections, midterm and end term exam is same. All the 4 sections, but other components can vary. Okay, so you understand? Okay, right. Yeah, the one expectation is that you should be these are the soft rules. What do you mean by classroom civility? We are the online session. I know that I'm not very cool in the sense that I want everyone to be presentable when you wanted to attend the class. I don't want you to just get up from the bed and attend the class. I want you to be presentable. I will be presentable myself. Okay, I will come to the class as if I'm going to the physical class. Okay, so the issue is that if I let you lose now, by the end of the course, I don't know whether what kind of situation I may end up facing. So everyone need to be presentable. You need to be professional yourself when attending the class. That's what I mean. Okay, it may sound uncool, but that's what I follow. Okay, right, you need to be clear on that. Yeah, but failure, by the way, by doing this you don't get any extra credit. By not doing, I will punish you with it. This is my stick. So just be aware of it. Okay, right. Yeah, so I will try my best to answer all the questions. If I don't answer the question, I will come back in the next class to answer your question. Okay, now there is a hell lot of material out there. You don't need to wait for me to come back, because you can search and you can find the solution for any doubt that you get in the class. But still, I will try to come back and provide you the solution, because there is no way that I will be able to answer all the questions that you might possibly pose during the discussions. Just be aware of it. Okay, right. That's precisely I have. I'm sorry I've taken more time, but this is what is quite often happening during these online sessions. So I don't want to cut short at exactly 12 o'clock and say that we are done. So yeah, I'm done with the today's session. I will share the video as well as the class slides on the course page. If you have any questions, stay back. Otherwise, you can silently leave. Okay, thank you.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Sure.
Thank you, sir.
Thank you, sir.
Right. You can silently leave. Only those people who are having the questions stay back. I will be around for 10 more minutes.
Sir, I had a question regarding the pass-through security. Sir, in the initial orientation.
So which security?
The pass-through.
Okay, pass-through security. Go ahead, yeah.
Sir, I got confused. Sir, they are more similar to the regular bonds, but how do we distinguish between a pass-through and the other kind of security? So you bundle.
Go ahead. Explain. What is your doubt?
Sir, I tried to read more about it, but I was not able to understand. Okay, you are actually bundling a number of real assets, and then you have an intermediary in between, and then you are selling it off to the people in the market.
Right.
But that is how we all do it for the other bonds too. You have a bond, you have a corporate bond, you have a.
Jayesh, pass-through securities is a fixed income securities. Okay, so when we bundle it, what happens is bundle includes the various loans, right? The loans of higher quality, we keep it as a higher tranches. So what do we do when we bundle it? Okay, let me take another board. So when we bundle it, we slice into the various tranches. Sorry. So this is the loan book. Okay, these are the the least rated are the highly risky loans. Let's say these are the highly risky loans, 20%. 80% of this loan book is a safer securities. Okay, so we will tranche it, or we will further tranche it, or we will consider all this 80% as same, or we say that this is the highly rated, this is a little low rated, and we will sell. Accordingly, based on their ratings, because we will go for the separate ratings for each branches. So according to their ratings, they will command the different prices in the market. If the rating is lower, they will command the lower prices and the higher yields. Okay, higher returns in the market. They are similar like a fixed income securities. They are fixed income securities. It's some, let's say as an investor, you can invest in the corporate bond or you can invest in this pass-through bond. Okay, usually these pass-through bonds offers a slightly higher rate than the highly rated. Let's say there's a company ABC. It is rated as the AAA. Okay, it is issuing the corporate bonds, and there's a pass-through securities available which is also rated as a AAA. Usually, these pass-through securities which have the higher rating, generally they trade at the slightly higher yield. Few basis points or 20 basis points. 100 basis point is equal to the 1%. So 20 basis points, they generally offer a slightly higher rate. That's what is the difference. But otherwise they are the fixed income securities. They are like bonds.
As an investor, I don't need to worry about what
you don't need to be worried.
I just have to what the return is. That is the only concern that I should have.
Perfect. The only thing is that suspicion has raised after 2008 crisis. The suspicion suspicion is that even though they are highly rated, sometimes when compared to the corporation, their ratings are fluctuating so often.
So that is what is my question, sir. After 2008, sir, because they also did the same thing, sir.
Right.
Like you were saying that you trust it and you invest in the bond,
right.
and you only care about the returns, but the quality of loans after that, sir.
So what happened? Apurva here, since even though they are highly AAA rated when compared to the ABC, still people are not ready to pay the same price for the pass-through securities. So that's what they are offering the higher returns.
Yes,
higher
yes.
rate, so they are expected. So the issue is that experiences, it's not just about the ratings, the experience about these instruments says that these pass-through securities are slightly highly risky. That's what they trade at the few basis points higher with the with the yield of few basis points higher. But otherwise they are just a fixed income securities.
So then what could be the possible reasons of still investing in such a bond?
See, this perceptual difference of rating. See, this is also AAA rated, this is a AAA rated. Why we are differing, why we are saying that these are not really believable, because our experience says that these rating agencies may get carried away and give the higher ratings. And this questioned the very framework that is being used by the credit rating agencies. So nowadays they try to streamline their process of rating. So now they become more conservative. In fact, in rating the pass-through securities. After this financial crisis, we are not seeing, because they have become more vigilant. Now we don't see so many times corporations defaulting, but not the pass-through securities. So they started adopting the higher standards while rating the pass-through securities. So I don't see that now. We don't need to be, at the same time we need to be vigilant whenever we are investing the money, because our experience is somewhat shaky when it comes to the pass-through securities. But if you look at last 10 years, I don't see any news that any pass-through security defaulted. So that gives us some confidence that because it questioned the very framework of the credit rating agencies and their reputation. So that shaped their their policies in adopting. So I don't see any significant difference as long as they offer the higher returns, because it's already the credit rating agencies already gotten a hit. Now even if they further go down, it's a question of reputation. After all, it's for their survival. But having said that, there is always some amount of risk perception with the pass-through.
And so one more difference is, I think that in case of corporation issued securities, you can still search about the corporation and study about the corporation. But in case of these CDOs,
see, by the way, they give the details here. Even the CDOs, what kind of loans, to whom. Yeah, they don't give. You don't get to see that, or you don't get to assess how many people they are. How many people are going to. See, you can also argue other way around. A corporation can default, or few of the the people who are taking the loans within this bundle may default, but not the entire group. So you
Yes, sir.
again have the diversification also. So
Yes,
you
sir,
can
yes,
have
sir.
both the ways you can argue. So when you say that believing one corporation may be better than the multiple people, but you can argue from the diversification perspective. Putting your eggs in the bigger basket is better than the putting all your eggs in one basket. See, it's all about the our perception and how you wanted to pursue, how you wanted to see the instrument. Okay.
Yes. Okay.
So earlier you said that money market is a. So can you hear me?
Yeah, I can hear you.
Yeah. So money market is a subset of fixed income market. But in money market, in fixed income market, it's recurring, right? It's happening every year. But in money market, the securities are, traded. The lifetime is only 1 year.
Right. But
So
claim is fixed. Claim is fixed,
concept.
right? See, fixed income market. How did I say? By the nature of the claim, we classified the markets as a fixed income market and common stock market, right? The financial assets represents the fixed claim. Fixed income market is the place where the assets that trade having the fixed claim on the fixed cash flows. The nature of claim is fixed. So fixed income market, the claims are of fixed nature. Okay. So so what happens? What are the types of you have the bonds that offer the fixed claims, and you have the money market instruments, short-term instruments. So short-term instruments offer if it's a T-bill, you know how much you are going to get. So the claim is fixed. So from that perspective, I argued that the money market is a subset of the fixed income market.
Okay.
That's it. In terms of the nature of the claim, that's what I argued. Okay, right.
And so in the notes there was about the derivative instruments. Can you explain a bit about, because I was not getting the concept of underlying asset.
Oh, okay.
And,
see, derivative instruments are essentially contracts. Okay, this is nothing like an instrument as such. It's a contract. It derives the value based on the underlying assets. It's a contract. Let's say this contract gives you right to buy a security.
okay.
This contract gives you the right to sell a security, sell a asset. Okay, let's say I'll tell you now. Assume that for quintal, the wheat per quintal is 1200 in the market. You are a farmer. Assume that after 2 months you are going to get the harvest. See, you are happy with the 1200 price today, but by the time you get the harvest, you may not get the same price. You are worried. Your price may go down. By the time you get the harvest, by the time you had to sell the wheat, the price may go down. So you are worried. So what do? You enter into an agreement. Agreement gives you the right to sell the wheat at the 1200 2 months from now. Okay. Now just imagine.
Forward contract.
It's a forward contract. It's a contract. All the derivative instruments are the contracts. You have the right to sell. Now imagine by the time after 2 months, if the price comes down, if the market price is actually not the 1200, so 1050, but still you have the right to sell at the 1200 as per the contract. So your contract is valuable to the extent of 150 rupees.
So how are these traded? Suppose I have this contract.
Hold on. Let's have that confusion. We have the 3 or 4 sessions. We will study about the forward contracts. We will have the basic understanding. We are going to discuss. We have a complete course in the second year, derivatives and the options, derivatives and other instruments. Yeah. But in this course, you will get to know what is forward, what is future, what is all these contracts. What are these elements you will try to understand.
So actually, I've tried reading up a lot about this, but I was really getting very confused about.
No, that's okay. Confusion is not bad. Confusion is not bad. You keep reading. Okay. The issue is that by the time we get to study those, that's going to take another. We are going to spend after 17th class or 18th class. I may start discussing on the derivative instruments. So by the time, if you get some understanding by reading, so you will be better off after those sessions. So that's So I don't see anything wrong having confusion. Okay, right.
Yes, sir.
Sure.
Okay. Thank you, sir.
Sure. That's fine.
Hello.
Yes.
So can we end this meeting?
Yeah, I'm ending the meeting.
Okay.